Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins for a look at what investors need to know. And this week, we're also joined by David Broomfield. He's a multi-asset strategist here at Coutts, and you'll be hearing a lot more from David as we go through the year. Hello, David. Hello, Alan.
Hi, Sarah. Afternoon.
Hi, David. Yeah, I'm really pleased that you're going to be involved a lot more because my days are numbered here. But you can invite me back as a guest. Of course you can, provided I don't do anything naughty with a competitor. Who knows? Who knows? But yeah, so I've worked with David for over 10 years. He's our go-to person for economic and financial history. So I think it'll be fantastic. I really look forward to listening to it myself. Confession, like a lot of people, do listen to podcasts late. So it may be a couple of weeks in before I get to it.
Well, okay. Alan, we have to absolutely have you back. Where else are we going to get our anecdotes from Japan in the late 80s from? I mean, it's you. You're the font of that knowledge.
Thank you. That's one of. I've got many obsessions, David, but that's definitely one of them. You're quite right, and thank you for listening. That's a good sign.
Brilliant. All right, I can see I'm going to have trouble getting a word in edgeways today. Okay, let's kick off then with some chit chat before we get to the three things, because that's not changing. Jobs report, first of all. We don't normally talk about the data these days because, as like you said, Alan, a lot of people don't listen to the podcast the day it comes out. They maybe listen a week or two later. But you wanted to say something about the fact that we had some downward revisions in the last US non-farm payroll, didn't you?
Yes, Sarah, thanks for that. Yeah, one of my other obsessions, revisions. It's all about the revisions. And as we know, David knows this, UK GDP revised, always up. You know, yeah. we can't seem to add up. In contrast, non-farm payroll, so employment reports in the States, revisions all over the place. And big picture is big downward revisions because people who really pay attention to the macro would have been worried about very, very strong data. The big picture is after these downward revisions, and the way I look at revisions, it's the real number, you know, the flash number, who knows. I would just say the US economy is looking solid. Quite a nice place to be. Dare I say Goldilocks, not too strong, not too weak. So, I just wanted to mention that. The rest of the data was absolutely fine.
Yeah. So that soft landing then is still looking like we're on target.
Yes, exactly right.
Okay, brilliant. All right, that's that. The other thing is we did have a couple of messages in. The first one was we were talking last week. We were looking at bubbles and we talked about Bitcoin. And you made the comment that it was a dollar denominated asset. And we had Ed getting in touch with us, who's a CIO, and he took issue with that.
He did, yeah. This is a CIO I know quite well. And for someone who claims he hates macro, I have to say he's bloody good at it. Sorry. Slight swear word. He is very good at macro, very annoying. Spot on, because he's exactly right. Because, I mean, I made the point, what my conversion, and I should say, just in case we have new listeners, we're a broad church. We have people, complete believers in crypto. Yeah. We have people who are complete unbelievers, and people like me who are willing to take a positive view on Bitcoin. Why? Because talking to people from emerging and frontier markets, you realize that there's ability to get into dollars. So with the Nigerian currency down some 70 or 80% more recently, the Egyptian pound, a big devaluation, et cetera, you can go on. But Ed correctly points out that actually someone from Nigeria is doing a Naira Bitcoin trade. Absolutely right. And I'm tempted to say he's technically correct, except the problem with that, he's absolutely correct. But I stand my ground that I think a lot of even quite sophisticated investors in these emerging markets and frontier markets, they are attracted to getting into Bitcoin because it's denominated in dollars and have a dollar asset. Yes, of course, they have some belief that the Bitcoin may be going up, but even if Bitcoin's stable, even if Bitcoin falls a little, I say a little, then, if you look at the Lebanese pound, for example, that's down some 90%. You know, so the idea of getting out of dollars, but Ed, listen on, because you also put me onto a really good book, which I'm going to talk about later.
Oh, brilliant. Okay, good. All right. And then last but not least, this seems to be a bit of a perennial topic for us at the moment, surfing. We had a former colleague, George, who is an investment specialist, get in touch with us, and Ollie, who is a regular listener and a colleague of ours. And they both sent you, and then you sent on to me. There was a piece, was it in the Times, about the best surfing beaches in the UK?
Yeah, and Ollie, my God, he researched that because it's an old article, I notice. But it makes me worry. I don't know about you, David, about productivity in the UK. Is everyone just so obsessed with surfing? But anyway, David, how about you?
Well, I mean, look, I'll try not to be too indiscreet, but I know Ollie likes his long car journeys down to the southwest to find those hidden surfing spots. For me, I mean, as I was telling you before the podcast, I actually went surfing on my honeymoon, and I suppose, like I say, I've been trying not to get wiped out ever since. But surfing for me is going abroad, Alan. It's Portugal, it's California. It's the home of surfing, right? Some wonderful, ebullient, sunshine-kissed young person gets you on a surfboard, a nice big lump of foam that makes you feel like you've been doing it for 20 years. And you're sitting there in California. There's no better place in the world. Don't get me wrong, the southwest of the country is a beautiful spot, but it's all about California for me.
Okay. I'm still sticking with San Sebastian. Somebody's got to come up with a better place because they've still got the best food. Anyway, enough surfing. Let's get on to the three things we're going to be talking about this week. Now, because we've got both Alan and David on. So, David, you're going to get 2 topics. Alan's going to get 1. Just give us a heads up. What are your 2 topics that you want to talk about? Kind of related, I think, aren't they?
Yeah, Sarah, I want to talk about China again. I don't think we've really bottomed out this "is it cheap" discussion, and there's definitely some more mileage there. And then let's talk about how China sits as an economy and its sort of long-term structural pathway, and we can look at that within the context of other emerging markets as well.
Sounds good. And then, Alan, what's your point?
Yeah, I think really good point. I'm going to be really intrigued about the argument is China, especially because I'm a more of a market than an economics person. Is China cheap for a reason? So I've been looking at India, and people like book reviews, don't they? And actually, CIO Ed put me onto a book as a prelude. What I learned about investing from Darwin by Pulak Prasad, who's an Indian equity manager. More about him later, but I just want to get the title of the book out there. Maybe you'll mention it a second time so people can write it down. But basically, a bit of a comparison of India and China, less so on GDP, but on the markets. And quite frankly, I mean, many of our listeners will know this, the remarkable performance of India, and this is nothing to do with whether Coutts has exposure. Coutts has exposure to both through general EM, but just, I'll focus a bit more on India, and I'll be interested what David's view is as well.
Okay. All right, then. Well, let's come back to you, David. So when we did an episode of Need to Know with our CIO, Farhad Kamal, which was on the 31st of January, if you want to listen to that, where Alan and Farhad talked about their 3 surprises for 2024, or potential surprises. Farhad talked about China, and he described it as cheap and unloved. But I guess my question is, when is it cheap and when is it undervalued? That's the question, isn't it?
Well, it's a great question. I'm just looking at Bloomberg in real time here because I think our new CIO has got impeccable timing for that statement. I think 31st of Jan might have been the low. No, 2nd of February. He was almost right. And, when are things cheap for a reason? Are things cheap for a reason is obviously the question here. And I think when you look at the Chinese market, there's 2 main arguments here. One is it cheap because of the politicization of the Chinese economy? And what we mean there is, the intervention by the state in particular sectors. And, I don't think we can be immune to the geopolitical backdrop, right? There's certainly a lot of tension between East and West and China's position in things like Russia, Ukraine, Taiwan, even North Korea to an extent. So that's the first argument. And that argument is sort of underwritten by people citing the foreign direct investment data. Okay, so that's for those on the call that aren't into the big sort of macro statistics. That's where you make a meaningful investment in a country and have a kind of control in that investment. It's slightly different to just buying stocks and shares on the Chinese market. Sarah,
and that's at multi-decade lows, isn't it? Foreign direct investment.
Yeah, I mean, it's fallen off a cliff. There's some great charts out there. I'll try and get one onto the Coutts.com website to show everybody. But if you look at what happened from pretty much the beginning of 2022, it just fell off a cliff. And maybe Alan has got some insights of what that means for India, because if you actually look at the chart for India, it's much more positive. And there's an argument to say that that sort of spigot of FDI has just been moved from China to India. And if you look at that trend in FDI, it does give some credence to that politicization argument. And so, crackdowns on tech firms, the Chinese coming in with new national security laws about cross-border data. If you're going to build a factory, if you're going to make a big investment in China, all these things now are very much at the forefront of your thinking. But look, let's just step back a second. There are massive investments in China by Apple, by Tesla. They're already there. So, although the flows have fallen, the Western and particularly US direct investment in China is significant. So that's the first argument. The first argument is all about politicization. But the second argument is the one that I think I lean into, which is the structural argument. And I think let's talk about that a bit within the context of the very long run Chinese economy. So the structural argument is all about what we've seen for decades, this giant trade surplus that the Chinese have, coupled with this huge domestic savings rate. And this is nothing new. The world's been running that imbalance for multiple decades, where essentially those proceeds from Chinese exports become ultimately excess savings, which then get exported to the rest of the world on an unprecedented scale. Those flows ultimately, driven by the Chinese government, end up in US treasuries. Sarah?
Yeah, I saw a figure the other day that something like 28% of global savings are generated in China. And that compares to 33%, which is the combined figure for the US and the EU. Does that sound right? That seems incredibly high.
It is incredibly high. It's the largest, I think the largest savings rate in the world. I mean, some of these things are cultural, but also, the big question for investors over the last decade has been, when will this Chinese middle class stop saving and start actively participating in the stock market? I mean, we could do a whole podcast again on the Chinese middle class obsession with property and why that is. But, you've got 14% of the world's consumers in one country. If they start spending more than saving, then that has a huge effect on global dynamics. So this structural argument is all about the excess savings problem. And if I was sort of to summarize it in one paragraph, you'd say that high domestic savings rate, coupled with that big current account surplus, it just floods the domestic economy with liquidity. And if you don't have enough demand to soak up that liquidity, you end up directing it into places that you probably shouldn't, right? And there's a reason huge sums of money have ended up in Chinese property development projects. That accounted for about a quarter of economic activity until the bubble burst. So when you're thinking about those structural imbalances in China, when you look back at all those growth numbers, and there's some really impressive growth numbers, I think we've got to acknowledge that many of those came from property, a quarter of economic activity. So I think when you're thinking about, is it cheap, and you're being an equity investor, you've got to think about how you're going to participate in economic growth. You want broad-based economic growth fueled by corporate earnings growth. And the reality is, if you go back and look at, Chinese growth rates, which at times have been, monumentally impressive, whether you believe the official national statistics of China or not, they have been in double digits. On average, you've got, an average of just under 9% GDP growth per year, but the market has only delivered you just under 6, maybe 5.8% a year. So you're not participating in that Chinese economic growth story as an investor. So that's your structural dynamic, and that's the one that I think I lean into.
Okay. And related to that, I read a piece by Mohammed Al-Arian in the FT, and he'd been talking to various fund managers, and basically what he was hearing from them was that China at the moment, as far as foreign investors are concerned, is a trade rather than an investment. It doesn't have that long-term kind of view that fund managers are seeing. They're seeing it as a speculation for now. There's some opportunities there, but it's not a long-term investment. And that needs to change, doesn't it?
Yeah, absolutely. I mean, since the low of early February, you've had some intervention by the Chinese government, obviously, to buy equities. There's been a nice little rally actually since early February. But going back to that point that you made, Sarah, that's quite a technical argument. I think that is a rally from a low. To sustain the rally, you need earnings growth. Look, the Chinese market's about 13 times earnings. So let's say it's just under half as cheap as the US. So it is cheap on earnings, but I think it's convincing investors that you've got long-term earnings growth that you can participate in. That's what's key.
Okay. Alan, you wanted to say something?
Yeah, I think it's fair. I think the other reason it can be cheap for a reason, if you like, is corporate governance. Because obviously what we've seen, David, haven't we? We've seen the government basically say education, no. Alibaba and Ant basically no. And therefore being a minority shareholder where you need a discount. Now, the judgment call on the trade or the investment is how big is that discount? And there's no magic. It's a bit of a judgment call. Sounds like Farhad called it perfectly, as a trade at least, and I think that's fair. But that's what I would look for. I would be really looking for signs from the authorities that, if you like, I know I've said this before. You heard this from before, Sarah, that they really embrace minority shareholders. So that's a perspective. What do you think then, David? Cheap for a reason, does that mean, look, we can do trades, right? This is not about Coutts anyway, this podcast, but we can do trades and we can do longer term investments. We prefer longer term investments. Cheap or cheap for a reason? Where would you bias yourself?
I'd be slightly on the cheap for a reason side.
Yeah.
I think your point on governance, if you go back and look at the history of how the Chinese authorities have responded, and they will be acutely aware of that FDI chart I mentioned, that is such a big drop in foreign interest in deploying capital that if history is any guide, you generally see a pivot in foreign relations by the government. You see a more welcoming, conciliatory, accommodating attitude to foreign investment. That's what's happened in the past. I suppose it's whether it happens again, right? This goes back to what I've been talking about with clients and internally, that the world is now grappling with this multipolar dynamic of different power structures, competing on one level and cooperating on another level. So whether we'll return to that Chinese rhetoric of the early noughties when everything was about pro-business, I'm not sure. The corporate governance question is definitely key, though, Alan. You're right.
Okay. So what about the long-term picture then for China?
Well, yeah, I find the long-term picture fascinating. I mean, on a slight autobiographical note, before I went to university, I did a gap year where I spent a lot of time in China and Central Asia, and it just blew me away in the late 90s. The scale of the vision, the speed of development. I remember disappearing from a city of probably 20 million people that you've never heard of and coming back to that city 3 weeks later, and a whole skyscraper had pretty much been built over that time. And then post-university, one of my first jobs as an analyst, and Alan will remember this, a seminal paper in the early noughties, Dreaming with the Bricks by, I think, Jim O'Neill. Right. One of my first jobs was to re-engineer that model. And that model was all about Brazil, Russia, India, and China, and the long-term economic growth. So that long-term growth, in a nutshell, is driven quite simply by labor, capital, and something called total factor productivity growth. And if you look at China at the time, it just had this sort of exponential rise. And you could forecast. And the one thing, there'll be a lot of people in our industry that express their forecasting abilities with utmost confidence, but there's very few things you can forecast with any reliability other than demographics. And the Chinese demographic story, particularly compared to other emerging markets, is quite interesting. So the long-term Chinese growth story was always going to plateau. You were always going to have this kind of 200 years industrial revolution delivered in 40, going from, in the West, we went from 6 children a household down to 1.8. China through the one-child policy, but also rapid industrialization, has pretty much done that in 40 years. So the long-term growth story for China, I think, is one that plateaus and slows. And I just want to sort of bring this to life with some statistics, because we get obsessed in the media with this idea that China will overtake America.
Yeah, that was what everybody said for a long time, wasn't it? At some point, China's going to be the world's largest economy.
So let's bring that to life with some stats. So if you look at that GDP China compared to GDP America, and you look at it on an exchange rate basis, okay, you could say the US is $25 trillion economy, the Chinese $17 trillion economy. It hasn't overtaken. But is that really a fair way to measure how big China is? If you look at it on a purchasing power parity measure, okay, on that basis, on the basis of how much goods cost in each country, China actually overtook America in 2016. And people might, throw questions back at the podcast that's, because there are pros and cons of both of these measures of size and scale. But if you look at it, what I think is almost irrefutable, if you look at it on electricity consumption, right? Because there's one universal truth across all developed economies, that as you get bigger, you consume, and more wealthy, you consume more electricity. And there are differences in the economic base of China versus other economies. There's more heavy industry, there's more manufacturing, but they consume on a like-for-like basis about 2 times the amount of electricity as the US economy. So whichever measure you look, it is just an enormous economy today. And it probably, I would say, it has already overtaken the US as a productive capacity, or as productive force. It is just enormous. 1.4 billion people, 14% of the world's consumers. So it is big today. Its future, though, is back to that point that I think I touched on earlier, which is about the middle class, the Chinese consumer. How do they feel comfortable in participating in the stock market? How do they feel comfortable not having this sort of excess savings rate that we've seen? And I think I'll sort of conclude on a final point. And let's bring it back to Japan, shall we? Because I know Alan loves talking about Japan. You saw a similar trend in FDI, in net exports of FDI in Japan in the late 80s. You saw them all of a sudden switch to effectively exporting capital to the world, and it all came to an end in tears when the Japanese property bubble burst. But in the decades that followed, the Japanese economy benefited from the repatriation of all of that outward FDI back to Japan.
Yeah,
and I think the question is, we know that a lot of investments have happened from China going out to the rest of the world over recent years. Some of that has been geopolitical. You are suffering as a Chinese automaker from US tariffs. Well, you go and build a factory in Mexico. So I think the big question now is whether some of that external wealth creation starts being repatriated back to China, and then fuels a middle class, and perhaps even creates a different dynamic there. I don't know. I'm starting to lean back to this idea that China's growth expectations should be viewed within the context of a developed, mature economy, not an Asian tiger, as they were coined in the early noughties. I think double-digit economic growth rates shouldn't be expected anytime soon, or at all, for that matter.
I guess it's what you're saying then is, or if I understand you correctly, that it's inevitable then that the speed with which they went from one of the poorest economies to one of the world's largest economies. I mean, no other economy can match the speed with which they transitioned. It's inevitable then that they will at some point, or they have already perhaps, plateaued. And and as you say, now they're going to start growing in the way that a developed economy grows, not the way an emerging market grows.
Yeah, I think so. And so as investors, as analysts, we've got to look at it through that lens, like export-led growth, and that what drove China through that rapid industrialization and growth isn't necessarily going to take it to its next destination. Alan, sorry.
No, David, I think you make a really interesting comparison, Japan and China, because you're exactly right. So, as we know, the situation in Japan, my obsession, debt, government debt, 300% of GDP, not a problem. Why? Because it's a wealthy country. Exactly as you said, all those overseas investments over multiple years. So it's net external creditor. We're getting very economics, just wealthy from many, many coupons, either from direct businesses or treasury bonds or whatever. And so if you look at China's situation, where its debt to GDP, government debt to GDP is 60 to 70%. Okay, China's not there yet in terms of external assets, but it's going there. It means that China potentially, by analogy, has a lot of room on the fiscal side to really get their economy back on track. So from an economics perspective, I'm more optimistic, if you like, than I am on a market perspective. But it's an interesting comparison.
So I think that before we talk about India, Alan, I think there's one where, if we go back to this point, if what would make China a compelling investment case right now? Well, certainly a middle class consumer that was willing to spend would help. And I think when you go and look back at participation in economic growth, either as an equity investor or as a Chinese middle class consumer, I think there's some interesting stats, particularly if you compare China and India. And if you think that economic growth, what you want to see is, through that rapid industrialization process, you want to see a kind of equal participation in economic growth by people in China or people in India or whatever the emerging market is. And if you go back and look at the growth from 1980 through to the sort of 2010s in China, you can see that, of the top 1% of wealthy individuals in China participated in sort of, went from sort of, deriving their wealth from sort of 7% of economic growth to 13% of economic growth. And in India, that same 1% were driven from, I think, 10% to 22% of economic growth. So my point is that in India, about 22% of economic growth goes to the top 1% of wealthy individuals. And in China, the same stat is about 13%. So, as a Chinese individual, whether that's due to the political construct, not sure, you are getting wealthier more broadly than you are perhaps in other emerging markets. So if you can get that middle class consumer to spend, there is money there to be spent, is what I'm saying.
Just maybe not property.
Sorry, Sarah, to jump over you. Yeah. And look, you don't have to run an economy for the benefit of the stock market. It's just that's our interest. But maybe it's a good time to segue into India and China, because you looked at some very longer term data. I just looked at the last 10 years. And if we look at GDP for the last 10 years, basically roughly the same, 8 and 7. So, okay, I know 8% versus 7%, so 8% China, by the way. When you compound that, that's a lot more. But I think given the errors in growth measurement, the natural errors, natural difficulty, roughly the same. But this is the key, at least over these last 10 years, because I've said this before, Sarah, haven't I? The truth in markets is always earnings.
Yeah.
And I'll round just about. Basically, Indian earnings over the last 10 years has more than doubled. Okay. Amazingly, Chinese earnings, and this is MSCI China, and people will say, well, that's not the whole market, that's fine, but Chinese earnings are down about 20-30% over 10 years. Even UK earnings are up somewhat over 10 years. And therefore, when you look at the last 10 years, I think, David, your numbers are much longer term, and 20 or 25-year data looks a bit more favorable in China. But last 10 years is remarkable. Again, rounding. The truth is earnings. Chinese market up 10% in dollars. There's a bit of currency depreciation in there. Indian market up 170% in dollars. So basically, India, for whatever reason, has done a much better job of converting growth into earnings and therefore stock market performance. David?
So I want to, going back to that big long-term growth model. Remember I said it's labor, it's capital, and it's this thing called total factor productivity. If you look at what India's been doing with this total factor productivity, this idea of how do you basically turbocharge capital and labor into economic growth, India has been investing massively in infrastructure, massively in water, electrification, roads, bridges, and it's absolutely turbocharged economic growth and created that sort of positive earnings dynamo that you describe. I think that the long-term picture for India on those metrics, take demographics as an example, is very positive. India's working age population goes a lot further out on the curve than China's, and it plateaus for a lot longer. And they've got much more favorable participation rates. I mean, they've got, favorable demography, but it's slightly offset by participation rates. I mean, particularly female participation rates very low in India.
True. And I mean, there's a lot of remarkable things when you look at this. Firstly, as it stands today, I think it's worth pointing out that India is at record expensiveness. Think of India as almost like the NASDAQ of emerging markets, record expensiveness relative to China. So you have to have, a bit like buying into the Magnificent Seven today, you have to have a leap of faith that earnings can continue. Yeah, absolutely. But there's some remarkable things. So David, obviously investing in banks virtually anywhere has been a disaster, not just China. We know here in the UK, outside of JP Morgan, it's hard to find a bank that's worked. Have a look at India. Okay, over the last 20 years, HDFC and others, one of the main Indian banks, is up 32 times. They've delivered on earnings. It really is quite a remarkable story for whatever reason. So I'll mention this book. So Ed put me onto this book, What I Learned About Investing from Darwin. It's a team, as a Prasad, Prasad. If you read it, you'll do nothing but quality investing. He takes Warren Buffett's style quality investing to the extreme. And it wouldn't be a need to know without active versus passive. Actually, both India and China, to be fair, active tends to do somewhat better. It's a better area. And look, his particular fund is not available in UCITS at all. So it's not really relevant. But the quality style, so finding quality investments in India, including amazingly banks, has worked incredibly well. And it's a bit sad, isn't it, David, that China is not there? But, I am looking for the administration for tentative signs that they'll embrace. So not this stock market buying. They will embrace better corporate governance. It does seem to be, on the surface, nothing's perfect about India, but somewhat acceptance of a minority shareholder doing very, very well in India.
Is that then what India's getting right? If we want to use the word right, I don't want to make a judgment here, and perhaps China's getting wrong. Is it the corporate governance then? Is that one of the things why China seems to be doing better? India, I should say, is doing better.
From a stock market perspective, yes, but not necessarily from an economy perspective.
Yeah.
You could argue that the Chinese authorities will say, yeah, the stock market's interesting, but don't really care. What I care about is China being strong in semiconductors and in healthcare, et cetera, I don't really care if the stock market delivers it, to be fair. We're interested in the stock market, David, aren't we? Because that's our day job, amongst others. But so, what do you think, David?
Well, look, I think that this is a really important point. If you look at the numbers, the Indian middle class only accounts for about 3% of their population, and they are very underinvested in their domestic stock market. Contrast it to China, the number's much higher in China, and so I suppose back to this point on participation, it's just different, isn't it? So in China, this corporate governance question is obviously burning, but in India, it's more about where wealth is concentrated. It's just concentrated in much more narrowly with a smaller subset of the middle class. So, it's not a corporate governance question, but I suppose it's, what you want with an emerging market economy eventually is to see domestic investment in their own businesses, their own their own companies, and that dynamo start gathering momentum. And I think there's a more compelling story if the Chinese government can motivate that middle class. That's the question. My personal view here is that we sitting in London, the other side of the world, you've got to look at the Chinese system not through the lens of our system, but through the lens of theirs, where the state's balance sheets, regional prefecture balance sheets, and individual businesses and individuals' balance sheets are one and the same thing when the government want them to be. And so the ability to mobilize capital when the government want to mobilize capital is just different and profound compared to other regions. Sorry, Sarah.
I just wanted to ask one question, Alan, of you about India, because we've talked about, as far as foreign direct investment goes, we've talked about the challenges for China. But what about India? Because we had this case last year of short selling of Adani, and we've now had the Indian market regulator come out and stipulate that large foreign investors have to reveal their end investors. Is that something that is going to deter investment in India, or we don't see that as an issue?
Yeah, I'm glad you mentioned that, because, well, firstly, it's fair to say that, corporate governance, well, it's challenged all over the world, including in the major economies, as we know, whether you're going to talk about Wirecard in Germany or, many issues in the States back in the day. So, India's had its challenges. Yeah, so there is a scenario where India becomes a bit less friendly to minority shareholders. And I think highlighting ultimate ownership, I don't see too much of an issue with that. I'm a big one for disclosure. But hostility and wiping out profits, which we have seen to a certain extent to China, I'm not seeing that in India. But I'm glad you mentioned Adani, because it just goes to show, well, they have their issues as well.
So I guess what we're saying then is India, attractive, it's interesting, offering very good sort of earnings for an emerging market. China is cheap and unloved at the moment, but that they need to galvanize that middle class. They need to have more investment within their own country from a middle class point of view. And there's no reason why, and perhaps maybe sort out some of the issues around corporate governance as well and make it more attractive, perhaps again, for foreign direct investment. But essentially, we're saying it's not something to be written off, is it? It's far too big an economy to be written off.
Yeah, maybe I jump in, because Justin said India attractive. Historically, absolutely has been attractive, has been a place to invest. Going forward, it's a judgment call. We say this a lot, don't we? Theories. So the theory is basically paying this relatively expensive price, a bit like paying the expensive price for the Magnificent Seven. Is earnings delivery going to continue? That's a big question. Yeah. We're not going to answer this now. Probably, David, we might even have to get an external guest on in many months to come to answer that. That's a very specialist area. At the end of the day, David and I are generalists. So I wouldn't want our listeners thinking Coutts is saying India is attractive right now. It's too hard a judgment call.
Yeah, no, that's a very fair point. A reminder, Alan, of that book you recommended before I get to the disclaimer.
So, yes, what I learned about investing from Darwin. So obviously there's a lot of biology in there as well. I have to admit, I did skip some of the biology. Sorry, I'm an investment geek. I focus on the investments. By Pulak Prasad, Prasad. It's basically about quality investing. And he does it in India, and he's done it phenomenally well. His track record's in there. It's extraordinary. Congratulations. If you happen to listen, please send us a message if you do. You come away from this thinking, why bother with any other style of investing? But of course, then you kind of come back down to earth and realize there's more than one way of skinning the cat. But still, it's worth reading.
Okay, and I know David's a big bibliophile, so I will be expecting lots of book recommendations from you, David, over the coming weeks and months.
They will be varied and eclectic, I can assure you.
Excellent. Thank you very much. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you very much, Alan and David, for joining me this week. And thank you, everyone, for listening, for your comments, your feedback, your suggestions regarding surfing venues. It's all very, very welcome. We'll be back next week with more Need to Know. Until then, bye for now.